A very good morning to all of you students. My name is C. Divas Gupta and today we will be continuing on the topic of mergers and acquisitions. So students, in our previous session, we discussed about the basics of mergers and acquisitions, the different types of mergers and acquisitions, some of the different calculations that we are supposed to do in this topic, specifically for purchase consideration when it comes to swap ratio and even the valuation of the business when it comes to the cash payment for the mergers and acquisitions. And we also said that we will we will also go through some of these things. Let's say if A is taking over B Limited, or let's say B Limited is getting merged into A Limited, then the entire discussion will be around that what is the A Limited's value, what is the B Limited's value, what is the swap ratio, and then what is the post-merger analysis. Okay, yeah, Abrikeji, you're saying before we proceed, I have question for solution to question 5. Yes, please go ahead. What is your question?
Sir, last portion of the solution for December classes, last session, I mean, where just before we have compared the two options,
Yes,
in case
I'm
if you
just
must,
going to that. Yeah,
yeah,
here. Yeah.
just a minute, just last two lines. Come down.
Sorry, your voice
Sir,
is
yes,
little low.
yes, yes. Hello, I feel it. Just a minute, sir.
Yeah, yeah.
Hello, sir. Hello, sir. It's okay.
Yes. Yeah, yeah.
Sir,
Better, sir.
last line, we have 95.70 minus 75.
This one, yes. Okay.
Yes, divided by 75, multiply by 100. So
Mm-hmm.
we have arrived at 20.70.
Right.
Okay. No, sir, just a minute.
Okay.
Okay. I thought that you have divided it by twice. That's why. I mean, that's how I got it. It's okay, sir. Thank you.
Okay. Okay,
Yeah.
okay, okay. This is fine.
Thank you,
Okay.
sir. Yeah. Thank
Perfect. Perfect. Now let's come to question number 8, students. Okay. Till question number 7 we have covered in our previous session. We are going to question number 8 now. Hanky Limited and Shanky Limited operate in the same field, manufacturing newly born babies' clothes. Although Shanky Limited also has interest in communication equipments, Hanky Limited is planning to take over Shanky Limited, and the shareholders of Shanky Limited do not regard it as a hostile bid. Sorry. So what do we mean by hostile bid? Means that if the takeover is done to basically to have a self interest, right, rather than in the interest of both the companies. If let's say only one company who is taking over want to pursue their own self interest, that is called as hostile bid, and it may harm the other company, right? But in this case, they are saying it's not a hostile bid; it's a regular bid. Now, the current earnings for Hanky and Shanky Limited is what they have given to us. Number of shares, percentage of retained earnings, return on new investments, and return required by equity shareholders. So they have given us some data points. Dividends have just been paid and the retained earnings have already been reinvested into the new projects. Henkel Limited plans to adopt a policy of retaining 35% of earnings after the takeover and expects to achieve a 17% return on new investment. So that means after takeover, can I write it here? After takeover, just for simplicity, retained earnings will go to 35%, right? Because they are planning to adopt a policy of retaining 35% and expects to achieve 17% on new investment, right? These are the two new data points. Savings due to economies of scale are expected to be 85 lakh per annum. That means this is the synergy benefit, students, right? This will come over and above their individual profits. required return to equity shareholders will fall to 20% due to portfolio effects. Okay, so here instead of 21, it will go to 20% for the new entity after takeover, right? Requirements: calculate the existing share price of Hanky and Shanky Limited. So that is what we'll have to do first. Find the value of Hanky Limited after takeover. Advise Hanky Limited on the maximum amount it should pay to Shanky Limited. So let's go step by step, students. So first of all, let's calculate the share price. Solution: existing share price. Shobji, voice is not coming. Okay. So yeah, sorry students, there was some issue at my end, I think. Yes. So we have read this question and then I was about to say that how do we compute now the existing share price of Hanky and Shanky Limited? Just a second. Yeah. So students, we have been given data around the retained earnings, right? Which is somewhere to do with growth. So what was the growth formula? I'm just writing it here. Growth is equal to B into R, right? So where B is what you retain into the business and R is what you generate a return on that investment, correct? So this is the growth formula that we have discussed, right? So can we make use of that because we have been given both B and R? So first let's calculate the growth. So growth is equal to B into R, where B is retained earnings. Because if you see students, practically what is growth? Growth is basically the extra amount that you are able to earn over and above your baseline. And that extra amount, how will you be able to earn? By investing, right? How much you are investing, whatever you are retaining, and how much you will be able to generate a return on that investment is multiplied by R, which is the return on investment. So the incremental amount that you have invested multiplied by the return that you are able to generate. Correct? So B is retained earnings and R is return on investment. Correct? Now, so growth here will mean for Hanky Limited, it's return on new investment 0.5 and 20%, right? So 0.2 multiplied by 0.15. which is actually 3%. Similarly, for Shanky Limited, 0.8 into 0.15, which is actually 12%. So you see, 3% growth is happening for Hanky Limited and 12% growth is happening for Shanky Limited. Now we are supposed to calculate the share price. Now all of us know, students, that using the dividend growth formula, right? MPS is equal to D1 divided by KE minus G. This is what we have discussed in our previous session as well, right? So D1 is actually what? D1 is the dividend that you are supposed to pay after 1 year from now. Okay. So if we talk about Hanky Limited, right? So 20% they have retained. That means 80% they would have paid. Correct? Of how much amount? 6.5 crore. So let's write it. 6.5 crore multiplied by 0.80. This is what their dividend payout would have been. But this is D0 amount. This is D0 amount. So to convert it to D1, we will have to multiply it with growth. So growth is how much? 3%. So into 1.03 whole divided by what is their cost of equity? Cost of equity is 21% minus growth of 3%. Clear? So this will give us the total market price. This will not give us the market price per share. So this will give us the total market price. Reason being, because this is this we have taken the total earnings, right? That's why it will give us the total market value. I would say not price, value. Okay. So if we solve for this, it becomes 29, 75, 55, 556. And this we will divide by the number of shares, which is 50 lakhs. It is given in the question, right? So MPS will be this, which is actually 59.51 per share. Okay. Similarly, for Shanky Limited, I'm just writing it over here. So 2.4 crore was their earnings, multiplied by 20% is what they have paid as dividend, because 80% they are retaining. Right? So 20% they have paid, and the growth is how much? 12% for them. We just now have calculated here. Right? So growth is 12%, and then cost of equity was 24% minus 12% growth. If you see here, cost of equity is 24%, students, right? So this will give us the value of MPS as 44, 8 lakh divided by 50 lakhs. Sorry, 15 lakhs. The number of shares are 15 lakhs. Okay. So it is actually 29.87 per share. I hope it is clear. So now if you see, students, we have just used whatever was given in the question in the form of retained earnings, in the form of return on investment and cost of equity to calculate the market price per share. Clear? Now the second part, find the value of Henke Limited after takeover. So we have just calculated here the value is itself, right? But now they are saying after takeover, if the new parameters comes in, then what is the market value? So for that, again, we will repeat the process what we did now, but for taking the assumptions that are given after takeover. Okay. So here growth. first of all will be, so let's write it after takeover. Growth is equal to, so how much we are retaining? 35%. How much we are earning? 17%. So growth is equal to 0.17 into 0.35, which is actually 6%. Cost of equity is also given to us as 20%. And next year earnings will be 6.5 crore plus 2.4 crore plus 0.85 crore on account of synergy, right? This all multiplied by 1.06, which is the growth for the, because we are calculating earnings for next year. And hence next year earnings comes out to be 1023 30,000, and hence next year dividend, which is also called as D1, will be this value multiplied by the dividend payout ratio. Dividend payout ratio is, if 35% I am retaining, 65% I will pay out. 65% minus 1023 30,000. So this is actually 6 crore 71 lakh 77,500. Right? This is what is going to be my D1. If this is my D1, then the market value will be D1 divided by KE minus growth. Right? Six 77,500 divided by 20% minus 6%. So which is actually 47, 98, 39, 286. So the value becomes 47 crore 98 lakh 39,286. Okay. Perfect. Now the last part, students. Advise on Henke Limited maximum amount it should pay to Shanky Limited. The comparison is simple, right? And this comparison we have talked about in our last session also, that if I am willing to pay, what is the maximum amount I'm willing to pay? I will definitely see it with a lens that what I have the value currently. If I take over something, what will be my net addition to the value that I will derive? Only that net additional amount is the maximum amount that I can pay, right? So my increased value will become this much. My original value is what we have already calculated in step 1. We will compare both. Whatever is the incremental is the maximum amount I can pay you that. Okay, in terms of the takeover. So step 3, combined value. 47, 98, 39, 286 less value of Hanky Limited before takeover. So this is 29, 75, 55, 556, right? If we reduce this, the maximum amount can be paid. Can be paid for Shanky Limited is actually the difference between these two, which is 1822, 83,730. Clear? So this is the maximum amount that I can pay because my current value is this much. The maximum value addition that will happen to me is this much. So I can pay a difference between these two, right, as the maximum amount. Clear, students? Perfect. Let's go to question number 9, students. MPLC and CPLC operating in same industry. Yes, Abrikesh.
Uh, Sir, first step, where you have calculated 6.5 crores into 80%.
Right.
Can you go to that? Okay. And then 3% growth. Now, how it has come to 29 lakh 75,055, this amount? I couldn't come to that amount because
Okay, wait.
80% of 6.5 crores uh, is,
No, we have to divide by 21% minus 3% also here.
that, okay. In that case, what is this 50 lakhs then? So after, okay, total value of the solution is 29 lakhs. Then 50 lakhs
Yes,
you are dividing. This is number
correct.
of shares. Okay, okay.
Correct,
Okay.
correct. So let me clarify here. Okay, total market value,
Thank you, sir.
yeah, divided by number of shares. Okay,
Yes, sir. Thank you.
perfect. Okay, let's go to question number 9. MPLC and CPLC operating in same industry are not experiencing any rapid growth but providing a steady stream of earnings. MPLC's management is interested in acquisition of CPLC due to its excess plant capacity. Share of CPLC is trading in the market at pound for each. Other data relating to CPLC is as follows. Profit after tax they have given to us and the combined entity. Residual net cash flow per year they have also given to us. Required return on equity they have also given to us. Balance sheet of CPLC is what this looks like, which is the company which is in the question to be acquired, right? You are required to compute the minimum price per share CPLC should accept from MPLC. Now, if you see what is the CPLC expectation, how much they should accept, maximum price per share MPLC shall be willing to offer CPLC. So that means now the calculation will shift from CPLC point of view to MPLC. Again, the same logic, right? What is the value addition? What is the current value? What is the difference? Floor value per share of CPLC, whether it shall play any role in decision for its acquisition of MPLC. The question is very much conceptually similar, right? But again, with some different data elements, right? So let's see this. So first of all, value of CPLC. Residual cash flow, right? What we are able to earn divided by KE minus growth, correct? We are able to earn 40 lakhs for CPLC, right? So 40 lakhs divided by what is their cost of equity? 11.25 minus growth is 0, right? They have initially said without experiencing any rapid growth, correct? So we are making use of this as 0. So this comes out to be the value of 35, 55, 5, 556. So 35, 55, 3.55 crore is the value that CPLC is valued at, right? Now the market price per share will be this 35, 55, 556 divided by the number of shares. Number of shares are given to us 5 million common shares, right? So we will put 5 million here. 7.11 pound, right? So this becomes the market price per share. Book value per share is how much? CPLC is how much? What is their net assets value? Either we can do reserves and surplus plus share capital, or we can do total assets minus liabilities, right? Whichever way we want, we can do that. So it is 2975, right? Book value of CPLC is 29,750,000 divided by 5 million. 5.95 per share. This is their book value per share. This is again market price per share. Perfect. Then value of MPLC. Similarly, let's calculate that what is the value of MPLC. Again, MPLC will also use the residual net cash flow per year divided by the required rate of return, right? So which is 6 million divided by 12.5% minus 0 of growth, because growth they have initially mentioned. So this is 48 million. Okay. Value of combined entity, right? Because the third column also they have given to us. Combined entity, this much is the profit, this much is their residual cash flow, and 12% is the cost of equity. So this will be 12 million divided by 12%. So this is actually 100 million, right? This is the value of combined entity. The value of synergy, if I may want to ask you, value of synergy will be calculated how? Combined value, combined entities value, right? Minus value of CPLC plus value of MPLC, right? So it will be 100 million minus 48 million plus 35 million. 55,556, right? All these put together will be their value. So this is actually 16 triple four triple four. Correct. Now this is the value of synergy. Now let's talk about what is the ask in the question, right? So the ask is the minimum price per share CPLC should accept. Should they go with book value? Should they go with market price per share? They will go with book value, right? Because they're talking about that what is the minimum price. So the minimum price per share, minimum price per share CPLC should recover from MPLC is 5.95, which is the current book value, right? Then the second part was that what is the maximum value that MPLC will be able to give. So that will be computed using this formula. Let me write it. Maximum price per share MPLC shall be willing to offer to CPLC shall be comprised as follows. Value of CPLC plus synergy benefits. See, if I'm just taking a calculation, I will say that, okay, this is your value. This is the extra synergy benefit that I will get, right? Divided by the number of shares of CPLC, right? This is the maximum amount per share I can give you. Whatever is your value divided by the number of divide plus the synergy benefits divided by number of shares. So this was 35 million 555,556 plus synergy benefits was 16 million 444,444, right? Whole divided by 5 million as number of shares. If we solve this, it comes to 10.4 pounds. This is the maximum price that we will pay. So if you see, there are three ranges now, right? One, the market price was 7.11. The book value was 5.95. And lastly, 10.40 is the maximum amount that the MPLC will be able to pay. Because MPLC will get synergy benefits also, right? Because of this deal. And hence they can factor into this equation. Lastly, if you see this numerator, okay, this is very much similar to the previous question's last part that we did. The total value divided by the the total value minus Hanky Limited's value, right? Which is the net increase in the Hanky Limited, right? That was there. And here it is in MPLC, what will be the net increase, right? So which is let's say this 100 million minus 48 million also. If you do, you will arrive at the similar solution. Okay. Perfect. Now the last question is, what is the floor value? So floor value per share of CPLC shall be so now they're asking that what is the floor value, right? So the floor value will be the price at which it is trading in the market actually, which is the £4. Floor value per share of CPLC shall be £4, which is the current market price, and it shall not play any role in decision for the acquisition of CPLC, as it is lower than the book value, current book value, as it is even lower than the current book. Perfect. So yeah, this was it in this question. Let's move to question number 10, students.
We found current market value as market price per share is
7.11.
7.11 and it is
Yes.
given 4 pounds in the question. So there is a difference.
There's even 4 in the question, right? Any
There is a,
question, Prakash ji,
there,
here?
I mean, there is a difference of 3 pounds, around 3.11 pounds.
Yes. So I'll tell you what happens. I'll tell you. See, this 7.11 we have calculated is a theoretical price. Okay. In theory, it should be 7.11 because if let's say you are earning this much and your cost of equity is this much, then you should actually be valued at 7.11. But market is valuing you lower. Let's say the people who are trading in the market is valuing you lower. Reason being because let's say they don't think that there is any future potential, and then the prices appearing in the market of 4 pound will be a result of the demand and supply of this, right? Apart from the fundamental calculation that we did. Okay,
Okay,
so there
that's
are
what,
other factors also which will bring down the prices to 4 basically.
right. Okay.
Okay, then let's
Thank
come to question number 10. Sorry,
Sir,
any other question?
yeah, sir. Abrakesh.
Yes, Abrikesh. Yeah, sorry.
Sir, in that case, when floor price or trading price is 4 pound, then why these, MPLC shareholders agrees to this arrangement? Because they are getting, when they go for selling their shares of C Limited, CPLC, they will get less amount.
Correct. So I'll tell you what is happening while they are taking over CPLC, they are taking over from the sense that they will want to continue, they will want to integrate their business into MPLC's business and hence derive its value because of that. So, for example, if you see the combined entity, I think this is a very good question. We should actually see to it. If you see MPLC individual statement is this, CPLC individual statement is this, but combined entity level, the metrics have improved. If you see 6 million and 4 million is 10 million, but combined they are earning 12 million. So this is the real motive behind this takeover. Okay. They are not seeing the shares to acquire and then to sell it. Correct? If they are purchasing it for the purpose of selling in the near future, then definitely 4 pound is the right valuation. But they are not thinking about that. They are thinking about to continue the business from CPLC into MPLC. Okay?
Yeah, but sir, this is from management perspective.
Hmm.
But when they put the resolution, proposal to the board shareholders meeting, in that case, shareholders might have, objected to that because they are anyway going to get less amount.
So, okay, now the question comes that what are they getting, right? Are they getting 4 pound equivalent value, or they are getting 7.11 equivalent value, or they are getting 10.4 times equivalent value? There are three
Yes,
values that in fact, there are four values that we have seen,
yes.
right? So, if you talk about 4 is what is current market price, 7.11 is the theoretical minimum price. In between, there was a book value also that was 5, right? Let's say this is the book value per share, and then 10.4 is the full potential amount, I would say, right? This is the full potential value. Correct. Now it will depend. Yes, you're right that the shareholders and management might want to consider all these factors and then take a decision that okay, maximum is this much. Okay, see, the way we are also saying is this is the maximum amount. It is not necessarily that the deal will also get closed at 10.4. Maybe the deal will get closed at 5 only. Because let's say the CPLC's bargaining power is not that much, or maybe lower than this, or maybe something between 5 and 7, right? So this is just a range that we are talking about.
Okay. Thank you, sir.
Okay. Let's move to question number 10, students. X Limited is interested to acquire PB Limited. X Limited has 50 lakh shares of rupees 10 each, which are presently being quoted at 25. On the other hand, PB has 20 lakh shares of rupees 10 each currently selling at rupees 17. So they have given you the number of shares and the face value of the share as well as the market price of the share. X and PB have a EPS of 3.2 and 2.4. They have given you that as well. You're required to show the impact of.
Sir, voice gone.
Hello? Yeah, just a second. I'm just changing the network. Give me a second. I think we're just creating a problem. I hope I'm audible and visible.
Yes, sir, now audible.
Perfect, perfect. Thank you. So, we were discussing about question number 10. Yes. So, we were saying that show the impact of merger on EPS in case the exchange ratio is based on the relative proportion of EPS. Okay. Suppose if X quote an offer of share exchange ratio 1 is to 1, then should PB accept the offer or not, assuming that there will be no change in the P ratio of X Limited after merger, and the maximum ratio likely to be acceptable to the management. Now, it is again asking you to calculate some of the data points. Now, let's go step by step and let's calculate the swap ratio. So, solution swap ratio will be EPS of the target company, which is PB Limited, divided by EPS of X Limited. So it was 2.4 divided by 3.2, which is 0.75 is to 1, right? This becomes the swap ratio. Okay. Now, let's see what is the overall earnings for both company. X Limited 3.20 multiplied by 50 lakhs 160, right? Earnings for PB Limited 2.4 into 20 lakhs, 48 lakhs, right? In totality, we have 2 crore 8 lakhs. These are the total earnings, right? The EPS was how much? Sorry, the swap ratio was how much? 0.75 is to 1. So we'll have to compute how many total shares needs to be issued, that we can compute easily. So the total number of shares to be issued is equal to 0.75 multiplied by what is the original shares that are issued, 20 lakhs, right? So 0.75 multiplied by 20 lakhs. So 15 lakh new shares has to be issued of X Limited to the shareholders of PB Limited, right? Plus existing shares of X Limited. So what we are trying to do here, students, we are trying to calculate the total earnings and the total number of shares to arrive at the earnings per share. So we have 50 lakhs, right? So in totality, we have 65 lakhs. Total number of shares is 65. 65 lakhs, right? EPS post merger 2 crore 8 lakh divided by 65 lakh, right? Number of shares, which is 3.2 per share. So if you see, the effect is like this for X Limited, PB Limited, EPS before merger 3.2, 2.4, EPS after merger 3.2 will remain 3.2, right? Because this is what it is. But this 3.2 will be adjusted for swap ratio to calculate the post merger EPS of equivalent value of PB Limited, right? This we have discussed in detail in our previous session. Why we are multiplying with this 0.75, right? Because one share pre-merger is not equal to one share post-merger in case of PB Limited, right? It is only 0.75 share equivalent, right? Hence we have multiplied it. So this is the post-merger impact. Now the second part, students. Suppose if X quote an offer of exchange ratio of 1 is to 1, then should PB should accept the offer or not, assuming that there will be no change in the PE ratio. Now let's evaluate this. Now since the question is indicating around PE ratio, let's calculate the market value as well, right? So PB Limited should accept the offer, right? Why? Because the above step we saw that 0.75 is the right swap ratio, but if it is 1 is to 1, then the incoming the selling company would be in a better off situation if the swap ratio is 1 is to 1. So we will limit our answer to this. PB Limited should accept the offer as 1 is to 1 swap ratio is higher than 0.75 is to 1 and PB Limited would be in a better situation with this swap ratio. I think all of you would agree to this. Any doubts, any questions, students, till now? We were here.
This is 1:1 because EPS before merger and EPS after merger is 2.4, right?
Yes. No, 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 no. This 1:1 is given in the question. If you see the B part, it says, suppose if the exchange ratio is 1:1, then will it be acceptable or not? Okay. So we are trying to base our answer on this, saying that if it is 1:1, then it is much better for PB Limited. Correct?
Right.
Perfect. Then the maximum exchange ratio to be acceptable to X. Again, from X Limited, the acquiring company's perspective, let's go back to the same discussion. What amount I will be able to pay? I will have to see what will be my post-merger market value. What is my pre-merger market value? The difference between these two is the maximum amount that I am willing to pay. Simple, right? This we have been discussing in almost every question today. But the only thing is, somewhere the facts are different and hence the likelihood of solving the question is also different. Okay. So the maximum ratio acceptable to X Limited. Total market value combined 2 crore 8 lakhs multiplied by what is the PE ratio? It was mentioned that the PE ratio will not change. If 25 is the market price, 3.2 is the EPS, can I calculate the PE ratio? Yes. Multiplied by P ratio of X Limited. So the P ratio of X Limited is equal to 25 divided by 3.20, right? So the total market value becomes 2 crore 8 lakhs into 25 by 3.20. So this is actually coming out to be 1625. This is in lakhs, rupees in lakhs. Okay. So this is the maximum potential value that can reach after the takeover minus current market value before takeover of X Limited. 25 is the market price per share. What are the total number of shares? 50 lakhs. 1250 lakhs becomes the current market value. 375 becomes the incremental value. So the number of shares 375 lakhs divided by 25, which is equal to 15 lakhs. Okay. Existing number of shares 20 lakhs. And existing ratio is 15 lakhs divided by 20 lakhs, which again comes out to 0.75 is to 1. Clear, students? See, in a nutshell, 1625 is the maximum potential value. 1250 is my current value. That means 375 is the net addition that I'm willing to pay. Now this 375 lakh converts into the price per number of shares as how much? If 25 rupees is the current market price, I will have to issue another 15 lakh shares to cover up for 375 lakhs. Another 15 lakh shares will be issued for X Limited. Now, how many what is the swap ratio here? 20 lakhs is the existing, 20 lakhs is the total number of shares that is existing with the PB Limited, and hence 0.75:1 becomes the answer. So the maximum exchange ratio acceptable to shareholder of X Limited is 0.75 for one share of PB Limited. Clear, students? Perfect. So both the parts, first and the third part, is saying 0.75 is the maximum exchange ratio for PB Limited. Let's come to question number 11, students. B Limited is a highly successful company and wishes to expand by acquiring other firms. Its expected high growth in earnings and dividends is reflected in its PE ratio of 17. Okay. So its P ratio is 17. The board of directors of B Limited has been advised that if it were to take over firms with a lower P ratio than its own, using a share for share exchange, then it could increase its reported earnings per share. Now see, they are saying that if they can take over the firms with a lower P ratio, okay, and then use a swap ratio to exchange it, then it could increase its earnings per share. C Limited has been suggested as a possible target for takeover, which has a P ratio of 10 and 1 lakh shares in issue with a share price of 15. B Limited has 5 lakh shares in issue with a share price of 12. Again, the facts are almost similar to what we have discussed in question number 10. Calculate the change in earnings per share of B Limited if it acquires the whole of C Limited by issuing shares at its market price of rupees 12. So they are saying that if it issues the shares at the market price of rupees 12, assume the price of B Limited remains constant. So let's put down both B Limited and C Limited. P ratio is equal to 17 for B Limited, and for C Limited the P ratio was 10. Shares that are in circulation is 5 lakhs and 1 lakh. MPS is also given as 12 and 15. Can we calculate the earnings using this? The P ratio and MPS? The answer is yes. So the earnings becomes how? Market price per share divided by PE ratio multiplied by number of shares. This will give us the total earnings. Similarly, market price of 15 divided by the PE ratio multiplied by number of shares, right? So this is what my earnings is. So 352 941, and here it is 1,50,000. So the swap ratio is computed using price of C Limited divided by price of B Limited, which is actually 15 by 12. So 1.25 is to 1. So higher number of shares to be issued. Okay. Hence the total number of shares to be issued by B Limited is 1.25 into 1 lakh, which is 1,25,000. Right? 1 lakh is the existing number of shares of C Limited. After issuing these shares, what is the total number of shares outstanding? Existing shares 5 lakh plus new shares to be issued 1,25,000. So it comes out to 6,25,000. Right? Then EPS after merger. It comes out to be 352,941. The earnings of B Limited. Similarly, the earnings of C Limited divided by the total number of shares. Again, this is very similar to the previous question, students. There is nothing new. Total earnings, total shares to calculate the EPS post merger. Okay, this we have calculated above as well. EPS post merger becomes 0.80. The present EPS is computed as 352,941 divided by 5 lakh is equal to 0.71 is the current EPS. So EPS of B Limited has increased. The main objective with which they have started has been fulfilled, right? EPS of B Limited is increased from 0.71 to 0.80. Clear? After takeover, right? So change in earnings per share we have calculated, right? If it acquires the whole. So it has been increased from 0.71 to 0.80. Clear, students? Any doubt, any questions till now? Let me check the other query handle as well. Yeah. Okay. So if you see the pattern of these questions, what these questions are all about some of the decisions, right? The decision that how much to be given as the swap ratio, what is the right value. Now, if you see, there are two different perspectives. One, there is a perspective of the buying company. Second, there is a perspective of the selling company. Buying company will always think that what is the potential value, what is my value, and the difference is the maximum I can bear. The selling company will say that, okay, this is something that I am currently my situation is, and this is the minimum that I should expect. Because if I go and sell in the open market, I can get this much, right? So both of them come from different perspective. Now let's come to question number 12, students. Elrond Limited plans to acquire Doom Limited. The relevant financial details of the two firms prior to the merger announcement are Elrond and Doom, market price, and the number of shares outstanding. The merger is expected to generate gains which have a present value of 200 lakhs. This is synergy, right? The exchange ratio is agreed to be 0.5. What is the true cost of the merger from the point of view of Elrond Limited? Okay, we have discussed about the formula true cost of merger. So let's apply that. Okay, so basically the true cost of merger from the point of view of Elrond Limited is basically the gain from Doom Limited's point of view. Okay, let's see how. Okay, let's see how. It's very easy conceptually, there is nothing much. So swap ratio is given as 0.5:1. Shares to be issued to Doom Limited into 10 lakhs. So 5 lakhs is the number of shares to be issued. Correct. 0.5 is the swap ratio. 10 lakhs is the total number of shares of Doom Limited. So percentage of Doom Limited in overall capital. 5 divided by 20 plus 5, right? 20 is the existing shares and 5 are the new ones. So 20% holding post merger of Elron Limited is represented by Doom Limited. Clear? Value post merger. So let's compute the respective market prices of both and add the synergy value. Simple. So it comes out to be 50 into 20 lakhs. 50 is the market price, 20 lakhs number of shares for Elron Limited plus 25 market price, 10 lakhs shares of Doom Limited plus 200 lakhs is the synergy. So this 1450 lakhs is the overall market value post merger. Now it has two parts, students, right? One, Elron Limited and Doom Limited, 80% for Elrond and 20% for Doom, right? So the what is now the true cost of merger? True cost of merger is that whatever post merger belongs to Doom minus what I have received from Doom. True cost of merger is equal to 1450 into 20%. This is what we have given to Doom, right? One on 1450 into 20%, this is what Doom has got, minus they have given to us the value of 10 lakhs into 25, right? So 40 lakhs is what we have paid them extra. So the true cost is actually 40 lakhs. If you see, this is nothing but on 200 into 20%. This is the synergy benefit that has been gone to them.
It's always true. This percentage of target company is that much percentage of synergy benefit,
Synergy.
or may not be.
No, no, you are right. The question is very appropriate. I would say in this question only it is true. But sometimes what
Okay.
happens if, let's say, they change that after merger, your PE ratio gets changed, your cost of equity gets changed, right? If these parameters are changing, then it is just not this, but because of these values also are changing, it will also have an impact.
Okay.
Okay,
So it's not a rule of thumb.
it's not a rule of thumb. Okay, see, this is an interesting question. Let me further elaborate this. So what happens, because this will help us build the entire discussion that we are having. So see, if I talk about market value, okay, post merger, what we will think is that it is market value of A Limited plus market value of B Limited plus any synergy benefits, right? This is what we will think. I think most of you would be thinking till here. But
Yes.
since we have already discussed about synergy, so let's add this as well. Okay. So let's say A and B are getting merged. Okay. But the market value as a matrix is dependent on lot many other things. For example, let's say the P ratio, which is actually the major multiplier of earnings on to arrive at the pricing, if it is 10 here, right? And P ratio is something that will derive your value. Now, what if the moment you announce that you will acquire this and there will be a synergy benefit of this, your P ratio jumped to 12? Because in market it can happen. Then what will happen? This equation will not hold true. This entire equation will not hold true because in this case the market value post merger will be somewhat higher than these all three put together. Clear?
Yes.
So so this will actually depend on these many things. Okay, now what will happen in such a case? The 20% of higher value will be there of Doom Limited, which will in a way be not be equal to only this 200 into 20%. Okay, perfect.
Yes. Yes.
Let's come to question number 13. Okay, MK Limited is considering acquiring NL Limited. The following information is available: earnings after tax, number of equity shares, and market value per share. MK and NN, they have given you these informations. Exchange of equity shares for acquisition is based on current market value as above. There is no synergy advantage available. Find the earnings per share of company MK Limited after merger. This is fine. Find the exchange ratio so that shareholders of NL Limited would not be at loss. Simple. They have already given us the ratio to how to be calculated and then to calculate the earnings per share post merger. So let's do that first of all. For first calculation of swap ratio basis market price per share. So market price per share of NN Limited divided by market price per share of MK Limited, which is 160 divided by 200. 0.8 is to 1. Number of shares to be issued: 0.8 into 3 lakhs, which is 2,40,000 shares, right? Everything is sorted till here. So the total number of shares post merger 12 lakh plus 2,40,000, right? 14,40,000 is the total number of shares. What is the total earnings? 60 lakh plus 18 lakh. This is given in the question, right? 60 plus 18, both of them put together. So this is 78 lakhs. So EPS post merger 14,48,000. So this becomes 5.42 per share. Okay. Then second is the exchange ratio acceptable to NL Limited. So exchange ratio basis EPS, right? See, with the given facts in the question, there are only two ways using which you can calculate the exchange ratio. One basis market value and second basis EPS. Market value is what we have computed above. So EPS of NL Limited divided by EPS of MK Limited. So the EPS of NL Limited, which is the target company, is 18 lakh divided by 3 lakh. 6 lakh divided by, 60 lakh divided by 12 lakh. 6 by 5. Number of shares to be issued by MK Limited, 6 by 5 into 3 lakh, which is 3,60,000 shares. This is the swap ratio of 6 by 5. So in this case, the EPS after merger, 78 lakhs divided by 12 lakh plus 3,60,000, which is actually 5. So EPS for NN Limited's shareholder post merger is equal to 5 into 6 by 5, which is equal to 6. It cannot be 5 only, right? Because of the very reason that one share pre-merger of NL Limited is not equal to the share post-merger, okay? Clear? Perfect. So let's move to question number 14, students. Sorry, my bad. What was the last part of the question? Would not be at a loss. Okay, now let's conclude this question. So we have seen that the new exchange ratio has come out to 6. Since post-merger EPS of 6 attributable to NN Limited's shareholder is similar to pre-merger EPS, the shareholder of NN Limited would not be at a loss if Swap ratio is 6/5:1. Earnings available for equity shareholders of NL Limited, 3,60,000 into 5 is equal to 18 lakhs. So MK Limited and NL Limited, 0.8:1 was the ratio, right? And here it was 1.2:1, which is 6/5 students, right? So somewhere the deal will get closed, let's say at 1:1. I'm just taking a hypothetical number, right? Somewhere it might get closed in between, because MK Limited will start with a lower number, NL Limited will start with the higher number. Okay. Question number 14, students. The CEO of a company thinks that shareholders always look for EPS. Therefore, he considers maximization of EPS as his company's objective. His company's current net profits are rupees 80 lakhs and PE multiple is 10.5. He wants to buy another firm which has current income of 15.75 lakhs and PE multiple of 10. What is the maximum exchange ratio which the CEO should offer so that he could keep EPS at the current level, given that the current market price of both acquirer and target company are this and this much, respectively? If the CEO borrowed funds at 15% and buys out target company by paying cash, how much cash he should offer to maintain his EPS? Again, the same thing. This part, the cash payout is happening, and this part, the exchange ratio is happening. Assume tax rate of 30%. Okay. So acquirer and target. PE multiple 10.5 is for the acquirer and target is 10. Net profits 80 lakhs. Net profits are 80 lakhs and 15.75 lakhs. MPS, market price per share, is how much? 42 and 105. EPS will be computed as 42 divided by the PE multiple, 4, and 105 divided by 10, 10.5. Clear? So we have computed the EPS as well. Number of shares. Now, yes. So if you see, you have the overall net profits and you have the EPS. Can you calculate the number of shares? The answer is yes. 80 lakhs divided by 4. Similarly here, 15.75 lakhs divided by 10.5. So here it is 20 lakhs and here it is 1.5 lakhs. Okay, so we have got the number of shares also. We have got EPS, MPS, PE multiple, and net profit. So we are sorted now in terms of the information. Now, the what is the question asking us to calculate? What is the maximum exchange ratio which CEO should offer so as to keep the EPS at the current level? So let's say let the number of shares to be issued to target company BX, then EPS will be, so this 4 is the current EPS, right? Is equal to 80 lakhs profit plus 15.75 lakhs profit of the target company divided by 20 plus X, right? So if we solve for X here, it comes out to be 393750 shares. Clear? So the exchange ratio 2.625 per share, which is how we have calculated 393,750 divided by 1,50,000 shares. Clear? So if you do this, then your EPS will be still 4 rupees. Okay. Then let cash payout be X. Here also, if the cash payout is happening, they are saying to keep the EPS as same. So 4 rupees is equal to 80 lakhs plus 15.75 lakhs. This will remain same minus. Here the cash payout is X. On that, they will be able to earn 15% and post tax of 30%, right? Whole divided by 20 lakhs, right? So this is the formula that we have already discussed, right? Profit of A, profit of B minus whatever cash payout has happened. On that, whatever earnings you would have done post tax, you would have to take that. Correct? So this becomes 95.75 lakhs minus 0.105x is equal to 80 lakhs. So x is equal to 150 lakhs. So the cash payout of 150 lakhs, if you do to acquire this company, the target company, then your overall EPS will still be 4 rupees, students. It will be equal to 4 rupees. So we have covered till question number 14. Any questions or any doubts, students? Any queries that you have till now? Yeah. Should we break for 10 minutes now? And then again, we'll start. Okay, perfect. So let's do one thing, students. In case there are no other queries till now, let's break and then let's again reconvene after 10 minutes. Thank you. Number 15. Let me see if there are any queries. No. Okay, perfect. So, question number 15, students. Just a second. Let me see one thing. Okay. XYZ Limited wants to purchase ABC Limited by exchanging zero point 0.7 of its share for each share of ABC Limited. Relevant financial data are as follows. Equity share outstanding for 10 lakh and 4 lakh. So this is for XYZ. There is a typo in this. You can just mention XYZ and ABC. EPS is 40 and 28. Market price is also 250 and 160 that they have given to us. Illustrate the impact of merger on EPS of both the companies. The management of ABC Limited has quoted a share exchange ratio of 1.1 is to 1 for the merger. Assuming that the P ratio of XYZ will remain unchanged after the merger, what will be the gain from merger for ABC Limited? What will be the gain loss to the shareholders of XYZ Limited? Determine the maximum exchange ratio acceptable to the shareholders of XYZ Limited. So let's first calculate the impact of merger. Let's put both the companies' data points and organize them. Number of shares, 10 lakhs, 4 lakhs. Right? This is what it is given in the question. EPS, again, part of the question, 40 and 28. Now, earnings. We will just simply multiply it 400 lakhs and 112 lakhs. 40 into 10 lakhs, and here it is 28 into 4 lakhs. Issue of shares 0.70 into 4 lakhs, 2,80,000. EPS post merger 400 plus 112, right? This is what we will just add it up. The overall earnings, right? Divided by the total number of shares. 10 lakhs plus 2,80,000. So EPS post merger is equal to 40. Yeah. So EPS
So
post.
exchange ratio is 1:1 or 0.70?
No. Initially it is 0.70, right? So if you see the opening line of the question, by exchanging
Yes, yes. Yeah, yeah.
0.7.
Yeah.
Okay. Yeah, so then the EPS post merger is 40. Now let's show the impact post merger of EPS between both XYZ and ABC. XYZ, ABC, pre merger 40 and 28, right? Post merger, we have got 40 for XYZ, but for ABC, it will be 40 into 0.7 multiplied by the exchange ratio, right? So this is 28. So there is no impact. Impact is nil and nil, right? The impact is nil and nil. Second, Now the exchange ratio they have revised to 1:1. So EPS is equal to, again, 400 plus 112 lakhs divided by 10 lakhs shares originally issued, 4 lakhs will be issued basis 1:1, right? The number of shares here is 4 lakhs, so it will be 4 lakhs. So in totality, it becomes 36.57 per share. This is the EPS if the exchange ratio is 1:1. Obviously, if you increase the number of shares, the EPS will come down. This is what it has happened. So the PE ratio will be 6.25, right? How? 250 by 40. So if you see 250 market price, EPS 40, right? So the the PE ratio, we can just mention market price per share divided by earnings per share, which is effectively 250 divided by 40. Okay, which is equal to 6.25 times. This is the P ratio. Now, basis this P ratio, if we apply to the EPS, so the revised market price per share post merger comes out to be 6.25 multiplied by 36.57 per share. So the MPS becomes 228.56. Gain to shareholders of ABC Limited, 228.56 minus 160. Right? Because 160 is their existing price. And since the ratio is 1:1, we can simply compare the post and pre market prices. It's because it is 1:1, that's why. Clear?
We have to find the gain or loss to shareholders of XYZ Limited, and we have found of ABC Limited.
Okay, wait. So, yeah, that is the third part. Okay, so we will come to the third part. We are just trying to see that what will be the gain from merger for ABC Limited. We are in the second part as of now. Okay?
Okay.
Yeah. So the gain will be 40 and 28, 68.56. Yeah. This is the gain to the shareholders. Now let's come to the gain or loss to the XYZ Limited. Gain slash loss to shareholder of XYZ Limited. Okay. The way it will come is, what is the market price of the merged entity? Just now we have calculated, right? Of
228.56.
yes, very good. 228.56 less market price of XYZ entity before
250.
merger, 250. Yes. So there is a loss of 21.44 rupees. Loss from merger. This is happening to XYZ Limited. The acquiring companies, there is a loss. Okay. Then the last part of the question. Determine the maximum exchange ratio acceptable to the shareholders of XYZ Limited. Now, since there is a loss, So 1:1 is not the right ratio. So they are asking then what is the right ratio, you calculate and let us know. Again, the same logic. Whatever is the value post merger, the full potential minus value pre-merger of XYZ, the difference is what I can pay maximum. Total earnings 400 plus 112. This is 512. Let's put it in rupees in lakhs. Okay. P ratio. We have just now calculated 6.25 times market value. Total earnings multiplied by P ratio. 512 multiplied by 6.25. This is 3200 lakhs. Right? Minus, this is the total market value, right? Minus market value of XYZ before merger. So this is 10 lakh shares into 250 market price. 10 lakh shares, 250 market price. Okay. So this comes out to be 2500. That means 700 lakhs is the maximum value of target company that can be paid. Now, basis the 700, the number of shares can be computed. Yes, the number of shares 700 lakhs divided by 250 price per share. So 2.80 lakhs shares to be issued, and hence the maximum exchange ratio 2.80 is to 4. That is 0.7 is to 1. That's the exchange ratio that needs to be used, right? Because maximum they can issue 2.8 lakhs worth of shares. Any questions, any doubt till now, students? I hope this is clear. So, in a nutshell,
How did we
yeah,
get this 4 in the exchange ratio?
yeah, this is 4 lakhs, the existing number of shares. This one. So 2.8 is what we are issuing, 2.8 lakhs, and 4 lakhs is they have existing. So the exchange ratio will be this much.
Yeah, right. Thanks.
Okay. So what I was saying in a nutshell, the principles of every questions are remaining same. The principles are from acquirer perspective, how will you compute the maximum exchange ratio, or let's say the maximum payout that you are willing to do, right? So that is the only question that we are trying to answer in most of the cases. Question number 16, students. Longitude Limited is in the process of acquiring Latitude Limited on a share exchange basis. Following relevant data are available. Profit after tax 120 and 80 rupees in lakhs. Number of shares 15 and 16. Earnings per share 8 and 5. Price earnings ratio is 15 and 10. You are required to determine the pre-merger market value per share. And the maximum exchange ratio Longitude Limited can offer without dilution of EPS and market value per share. Calculate ratios up to 4 decimal points and amount and number of shares up to 2 decimal points. Simple. Again, let's first of all organize the data. Let's use this data to compute the pre-merger market value per share and then the maximum exchange ratio basis EPS and market value. This is a relatively simpler question. solution. Let's first take longitude limited, then latitude limited. This is in lakhs, okay, rupees in lakhs. So the first of all, the profits after tax 120 and 80, right? This is their profit after tax. The number of shares that they are holding is 15 and 16 lakhs. EPS is already given 8 and 5. PE ratio they have given 15 and 10. Can we calculate the market price per share? Yes. This is PE ratio multiplied by EPS, right? In EPS, you multiply the P ratio, you will arrive at the market price per share, which is 8 into 15, which is 120. And here it is 10 into 5, which is actually 50. Clear? So we have organized the data. We have got an extra piece of information, which is an MPS, which we have used the PE ratio and EPS to calculate MPS. Then the first part, pre-merger market value per share. This we have calculated. This is the first part, right? Second part, for second part, let's calculate the exchange ratio. EPS to be same, right? Let the number of shares be X. Because here the request is that the EPS should remain constant. So this is 120 plus 80 divided by 15 plus X, right? So 120 is what? 120 is the profits after tax. So this is actually profit after tax combined divided by number of existing shares of longitude limited plus new shares to be issued. This is what we have mentioned here, right? So this should be equal to the existing EPS of 8 rupees. This one, right? So this comes out to be 200 divided by 8 is equal to 15 plus X. 25 minus 15 is equal to X. X is equal to 10. So number of shares to be issued 10 lakhs, right? 10 means here 10 lakhs. So the exchange ratio will be 10 lakhs is to 16 lakhs. 16 is the number of shares for Latitude Limited here, okay? That is 0.625 is to 1. So the EPS comes out to, okay, had we done this is EPS, had we done this basis EPS ratio that was 5 by 8, right? This would have been similar. I'm just trying to relate it to the equation that we have already studied as well, right? Simple. Then the second subpart was to calculate exchange ratio basis MPS. MPS to be same. Let equity shares to be issued be X. Again, let's assume it to be the X. Then let's see the overall market price per share remains how much? So this will be 120 into 15 plus 50 into 16 divided by 15 plus X, which is equal to 120. So how have we arrived at? 120 into 15 students is the market value, market price per share multiplied by number of shares, right? So we can say combined market value divided by existing number of shares of Longitude Limited plus additional shares issued. Right? This will give you the market price per share, and they are saying it has to be remain same, which is 120. So what has happened here? If we solve for X here, X is equal to 6.67 lakhs shares. Okay, so the ratio is 6.67 is to 16. That is 0.4169 is to 1. Okay, and had we calculated exchange ratio using MPS, it would have been 50 by 120, which is also equal to 0.41667 is to 1, which is almost equal to the above number. Okay, this is just for your reference. Clear? So the exchange ratio is also coming out to be same. Okay, students. Then let's come to question number 17. Simple Limited and Dimple Limited are planning to merge. The total value of companies are dependent on the fluctuating business conditions. The following information is given for the total value debt plus equity structure of each of the two companies. The probability, the Simple Limited and Dimple Limited, high growth, medium growth, and slow growth. Okay, the current debt of Dimple Limited is 65 lakhs and Simple Limited is 460 lakhs. Calculate the expected value of debt and equity separately for the merged entity. So they're asking us to calculate the expected value of debt and equity for the merged entity. Okay, they have given us the current debts of Simple and Dimple Limited as well. Now, if you see, there is a different value of the business altogether in case of high growth, medium growth, and slow growth. Okay, so let's try to understand this through solution better. So Simple Limited, high, medium, and slow. Total is 820, 550, and 410. Okay, this is for Simple Limited. Now, if you see, the debt value is 460, students. The debt value is 460. Now, the question is, when it comes to high, medium, slow growth, will the debt value remain constant? What do you think, students? If it is 820, 550, and 410, the value is changing. Do you also think the debt value will also be changing in these three different probabilities?
No.
Yes, very good. So it will not change. It will remain same. So 460, 460. But now in case of slow case, I have an issue here. Although my debt value is 460, but my overall business value itself has come down. My overall business value has come down. So what should be my debt value here? In case of a slow business, in case of a slow growth possibility, what will be my debt value? Is it 460 still, or it will be something else?
It's
Any
actually
guesses?
it's a constant amount, so it will not change actually. 460 remains 460. Only thing is
Okay,
negative net worth
but
will be there.
yes, the negative net worth will be there. But is negative net worth possible? I mean, if you see, can we demand the extra amount of 50 lakh from the existing shareholders? Do they have that liability to be paid to the company?
No.
It would be 50,
Yes.
50 like.
Correct. Why? Because there is a limited liability. Whenever we talk about a company's shareholders, they have a limited liability. Their liability is limited to the extent of unpaid share capital. And in the absence of information here, in case of an unpaid share capital, we will assume that whatever was due from them, they have already paid. That means they are not liable for any further payment to the company. Now, if we put 460 here, that means 50 lakhs needs to be received from the shareholders, which they are not legally supposed to pay. So hence, the overall value of debt itself will come down to 410. Okay, I'm just marking a star here for the explanation. Minus 50 in equity is not possible because of limited liability clause, and hence the value of debt stands out to be rupees 410. So this comes out to be the equity value as 820 minus 460, which is 360. 550 minus 460, this is 90. And then this is nil. Clear? So we have calculated the different equity values, right? In high, medium, and slow, the split between debt and equity is what we have calculated for Dimple Limited. High growth, medium growth, and slow growth. Okay, this is for Dimple Limited. The total value is how much? 1050, 825, and 590. The debt value of it is 65, 65, and 65. Okay, and hence the overall equity value is 985, 760, and 525. In this case, there is no issue as such, right? 65 will remain 65 in all the cases because the overall valuation is quite high. Perfect. So we have calculated the split of Dimple Limited just like Simple Limited. Now calculate the expected value of debt and equity separately for the merged entity. Calculation of expected value of debt and equity Simple Limited. High growth, medium growth, and slow growth, right? These are the three different patterns that are given to us. So we'll just see for debt first. So what is the probability? 0.2 into 460. Here it was 0.60 into 460 plus 0.20 into 410. Correct? So the respective dates multiplied by the respective probabilities. Total debt is 450. Now similarly, equity value will be 0.20 into 360 plus 0.60 into 90 plus 0.20 into 0, right? So from where it has come? 360, 90, and nil, right? From here these values have come. So this will be total equity of 126. The total expected value hence will be 450 plus 126, which is actually 576. Okay, students. So 450 is the debt value and 126 is the equity value weighted average. Now for Dimple Limited, Let's talk about high growth. Let's talk about medium growth. And let's talk about the slow growth. High, medium, and slow. So the debt value is actually 0.20 into 65. This remains same. 0.60 into 65. This also remains same. And 0.20 into 65. This also remains same because 65 is the flat value. So the total expected debt is actually 65 in totality. The equity value is 0.20 into 985 plus 0.60 into 760 plus 0.20 into 525. Yeah, all these three things. Total expected equity 758. Total expected value 758 plus 65, which is 823. Right? This is 758 plus 65. Simple, students. Now, value of merged entity. Equity for Simple Limited and Dimple Limited. 126 and 758. 884. And for debt, Simple Limited and Dimple Limited. So this is 450 plus 65, which is 515. Simple. So we have computed the merged entities' respective values as well. Okay, students, should we move ahead to question number 18 now? Okay, let's move to question number 18. The following information is provided relating to the acquiring company Efficient Limited and the target company Healthy Limited. Number of shares, face value of rupees 10 each, is around 10 lakhs and 7.5 lakhs. Market capitalization is 500 lakhs and 750 lakhs. Okay. P ratio is 10 and 5. Reserves and surplus is around 300 and 165. And promoters holding is 4.75 and 5 lakhs. So they have given you this information. Board of directors of both the companies have decided to give a fair deal to the shareholders, and accordingly, for swap ratio, the weights are decided as 40, 25, and 35, respectively, for earnings, book, and market price. So they are saying that we will calculate the swap ratio with these three different weights, right? Calculate the swap ratio and also calculate the promoter's holding percentage after acquisition. So they are saying that you also need to calculate how the promoter's holding will change. What is the EPS of Efficient Limited after acquisition? What is the expected market price per share and market cap after acquisition, assuming P ratio remains unchanged? Okay. And calculate free float market capitalization of the merged firm. So the question is asking us to compute certain parts post merger. Okay. So solution. So the first A part, which is calculation of swap ratio, Efficient Limited and Healthy Limited, right? Market capitalization is 500 lakhs and 750 lakhs. Then number of shares, students, is actually 10 lakhs and 7.5 lakhs. So hence the MPS, market price per share, becomes 50 per share here and 100 per share here, right? Then the P ratio, students, that is given in the question, 10 and 5. EPS, which is MPS divided by PE ratio. Okay, P ratio is 10 and 5, and then EPS is MPS divided by P ratio, 50 by 10, and here it is 100 by 5. So 50 by 10 is 5 and 100 by 5 is 20. So the EPS is 5 and 20 respectively. Share capital is 100 lakhs and 75 lakhs. So this is 10 into 10, right? Sorry. They have given us the face value as 10 each, 10 lakhs and 7.5 lakhs, right? So 100 lakhs and 75 lakhs. So this is 10 into 7.5. This is their overall share capital. Reserves and surplus they have given to us 300 and 165. 300 and 165. Yeah. Then overall, it's 400 and it's 240 here. So the book value per share is 40 and 32. Right? How have we computed? 400 divided by 10, 240 divided by 7.5. Clear? This is book value per share. See, why are we computing this? Because all of these information will be required to compute the swap ratio, right? Now, let's come to swap ratio. Let's go step by step basis earnings. So earnings per share is 20 and 5. So 20 by 5, which is actually 4:1. This is the weight and this is the weighted ratio. So this is actually 40% weight. So 1.6:1 comes the earnings ratio. Then B part is book value per share. So this is actually 32 divided by 40. 0.8:1, right? Book value was 32 divided by 40. 0.8:1. 25% is the weight, and hence it comes as 0.2:1. Then MPS is market price per share, 100 divided by 50, which is 2:1. The ratio is 35%, right? And hence 2 into 35% is 0.7:1. So the overall number is 2.5:1. The total of all these is 2.5:1. This is the overall swap ratio, right? Basis the weights that have been given in the question, right? So for every one share of Healthy Limited, 2.5 shares of Efficient Limited will be issued. Okay. Now, let's come to the B part within the first part, which is calculate the promoter's holding. First one, number of shares held by promoters post merger. So what was their existing holding, students? 4.75 and 5, right? So let's take them. 4.75 will be as is, plus 5 will get multiplied by 2.5. That's the exchange ratio, right? So in totality, they will have 17.25 lakhs shares in the name of promoters. At the same time, what will be the total number of shares post merger? Ten lakhs is the overall shareholding, and there it was 7.5 lakhs. So 10 plus 7.5 into 2.5. Okay, so this is 10 plus 18.75, so which is 28.75, right? Percentage promoters holding, this is actually lakhs. Okay, so total number of shares post merger is 28.75. The promoters holding is 7.25 divided by 28.75, which is equal to 60%. Correct. So the promoters holding post merger is around 60%. EPS after acquisition is what we will have to calculate in part 2. What is the EPS after acquisition of Healthy Limited? Okay, so that we can calculate. Now, basis this swap ratio, we know what is the amount of shares to be issued and what will be the overall earnings, and hence what is the EPS. So EPS after acquisition 50 lakhs plus 150 lakhs. This is the overall earnings, which is the respective EPS multiplied by the number of shares. 28.75 lakhs. So how have we computed earnings? 5 EPS multiplied by 10 number of shares. So this is 50 lakhs, right? Similarly here 20 EPS multiplied by 7.5 lakh number of shares. So this is 20 into 7.5 is 150 lakhs, right? So this is how we have computed 6.956 per share. Third, what is the expected market price per share and market cap of Efficient after the acquisition? Assume PE ratio to be the same. Okay. So let's compute first of all the market price per share using the PE ratio multiplied by EPS. This equation, it comes out to be 10 is the PE ratio, right? Multiplied by 6.956. Hence 69.56 per share becomes the MPS. Clear? Therefore, market capitalization is equal to 69.56 per share pricing multiplied by 28.75 lakhs shares, which is actually 1999.85 lakh shares. So the overall market capitalization one double triple 9.85 lakhs. Okay. Then the last part is to calculate the free float market cap of the merged firm. Yeah. So free float market cap is actually given by 1 minus promoters holding. This is actually free float market cap, right? So combined promoters holding was 60%. We have calculated in step number 2. So free float percentage is equal to 100% minus 60% is equal to 40%. Hence, free float market capitalization is equal to 40% multiplied by 199.85 lakhs, right? So free float market capitalization is equal to 799.94 lakhs. This is the overall value of the free float market capitalization, students. Clear? Any questions or any doubts, students?
How did we get this 6.956 EPS while calculating the market price per share in third case?
Sorry, can you repeat the question?
Yeah, how did we get this earnings per share of 6.956 in third part?
Okay, this one, right?
Yes.
So this we are using from here, step 2. Step 2, we have computed 6.956 per share as EPS.
Yeah, right.
Okay.
Fine, right, yes.
Yeah. Perfect. So before we go to the next two questions, 19th and 20th, given let's say today's time, let's talk about something um, on the theoretical part. Okay. Yes. So we'll cover the balance two questions in the next session. So let's now talk about some of the theoretical part. Okay. Now, students, sometimes the discussion is that what is the rationale for mergers and acquisitions, right? Now, if you see that why do companies resort to mergers and acquisitions? So there are many reasons. The first reason is synergy, wherein value of A plus B is greater than value of A plus value of B. This is the old company. This is again the old company, right? So we are saying that the combined entity's value is greater than the value of the individual companies put together, right? And we have seen in a lot of questions also that this synergy arises because of the economies of scale or some of the overheads getting reduced, some of the concentration of the let's say their collective power now to negotiate with the suppliers or with even with the customers. Okay. Second is diversification. Okay. So diversification is basically where we reduce the unsystematic risk. Okay, wherein we say that, okay, if let's say A is part of the SMCG, B is the real estate, both of them will be combined and hence the unsystematic risk will get reduced. This you would have discussed in the portfolio management section, right? Correct. So diversification is the key to reduce your unsystematic risk, and for mergers and acquisition, this is one of the form. Third part is around taxation. So what happens, students? The weak company, by weak company means the company which is having some, let's say, accumulated losses. That company is having accumulated losses, which from tax point of view can give some of the benefits, right? The strong company takes over this weak company. In the anticipation, these accumulated losses will be adjusted against future profits and they will be able to utilize this tax benefit. You're getting my point. Hence, this is also one of the rationale for the companies to enter into mergers and acquisitions because they are getting a benefit of tax here, students. Okay. Then the next part is around growth. So growth of, let's say, A Limited is having 1000 crores of revenue in year 1, right? And in year 2, the revenue actually grows to 1100 crore. There is a 10% growth, right? Now, post acquisition, let's say, of B Limited, which is having a revenue of 600 crore. Now, the growth will look like from 1000 crore to 1700 crores. Out of this, 600 crore is inorganic growth. We call this as inorganic growth, and 100 crore is called as organic growth. Organic growth means which is coming on the similar base, right? So some companies resort to mergers and acquisitions to show better growth, to consolidate their revenues and even their bottom lines, to show a better organic and inorganic growth to their overall aspirations for the future, right? So growth is also one of the big factor for them to do the mergers and acquisition. Then the next part, students, is around consolidation of production capacities and increasing market power. So this is also one of the reasons. So the consolidation of production capacities and increasing market power. So A Limited is, let's say, having 60% of the production capacity. B Limited is having 10%. Both of them gets merged in totality 70% of the production capacity of that industry is held by them. Let's talk about a steel industry, or let's say an iron industry, right? So 60% of the supply is currently happening from A, 10% is from B. Both of them decides to merge together. They are now controlling 70% of the supply for the industry, right? So this is consolidation of production capacities. Similarly, about the market share, right? A and B Limited can have different market shares, but if they combine put together, they will they will become the market leader, because let's say both of them combined put together now are having more than 50% of the market share. Okay, clear? Then the next one, types and forms of mergers and acquisitions. Now, what are the different types and forms of mergers and acquisition? The first type is actually horizontal merger. This is a case where, let's say, both A Limited and B Limited are horizontal to each other. They belong to the same industry. That's why they are called as horizontal merger. Okay. Same industry means where there there are common set of customers who will consume your product. So A Limited and B Limited are competitors to each other. Both of them merge. They are called as horizontal merger. Second, vertical merger. Herein, A Limited to C Limited, let's say C Limited is the customer, A Limited is the main company, and then B Limited is the vendor. Okay. So if C Limited gets merged and B Limited also gets merged into A Limited, this is called as vertical merger. Okay. This is called as forward integration, and this is called as backward integration. Where the vendor gets merged into the company, this is called as backward integration. Where the customer gets merged in the company, that is called as the forward integration. And overall, this is called as the vertical merger. Here, the merger happens between those parties which have a buyer-seller relationship. Okay. This is for vertical merger. This is for horizontal merger. Then third is actually conglomerate merger. Okay, so conglomerate merger is the place where A Limited and B Limited, both of them are actually unrelated in terms of the nature of business. They are into the different lines of the business. Unrelated when it comes to their nature of business, right? Then comes co-generic merger. So co-generic merger means where their genre is similar. That means they are having both some commonality. For example, A Limited, B Limited, let's say they are part of the same industry or same factors. Some factors are common. Let's say example, some technology that they are using which is common. Okay, they have a common distribution channel. And their product line is similar. I'm not saying they have a similar product, but their product line is similar. Let's take an example how. Okay, there are, let's say, two NBFCs one is into the auto loans, and second NBFC is into the credit card. Okay, their product is not similar. One is for the auto and one is for the credit card, but they have similar genre in common, right? For example, see, they will have different customer. Yes. They will have industry. They belong to the industry of giving loans. The answer is yes. They are from a similar industry. Okay. They have a common distribution channel, let's say through agents. Distribution channel is through agents, and then they have similar product line, right? If both of them that decides to merge, that is called as co-generic merger, students. Okay. Then the next part is actually reverse merger. So generally, students, if you see, the large company takes over smaller company. But in this case, there is a private company and there is a public company. So private company here takes over public company, and in a way, this private company goes public without issuing IPO through this acquisition. And this public company, although it's listed, but let's say it's having some of the losses with it, right? So this private company will make use of this opportunity and it will go public by acquiring that public company. So this is why it is called as a reverse merger, because here the smaller company is acquiring the bigger company. Then lastly, through acquisition, right? We have already discussed acquisition is when you purchase the majority stake, when you take over the control. So purchase majority stake, or second, control board of directors. Right? This is through acquisition. So these are some of the different types and forms of mergers and acquisition, students. Right? Horizontal merger belong to the same industry. Vertical merger, maybe a supplier or a customer relationship. Conglomerate merger, where the two companies are unrelated to each other, but they have, in terms of the similar line of the business, they are totally unrelated. Co-generic, they have something in common, whether a distribution channel, product line, some common technology that they are using. Reverse merger, where a smaller company takes over the bigger company and the intention behind it is to go public. And lastly, the acquisition part. Okay. Any doubts, any questions, students? Now, ultimately, we are left with two questions. One is on demerger and second one is on the merger of banks, question number 19 and 20th. This we will be taking up in our next session. I think this was it from today's session from my end. Now I request C. Ashish sir to please help with the concluding remarks. Thank you, sir. Thank you, students.
Thank you, Divas sir. Now, student,
Thank you.
in the end of the session, we have discussed the concept of reverse merger. And I think in today's time, it is also equally important because now when we say that the merger is a way of gaining the synergy, so we can also say that reverse merger is also the way to entering into the market. Okay, somewhere we can say that because it helps any company to enter into the market through this route. Am I right, Divas sir?
Yes, sir. Yes, sir. Totally
and
correct, sir.
and not only that, it also create the values. Sometime it has been observed that, and even especially in case of when we talk about split offs and spin off, etc., so it creates a value because once now recently there are some cases where the I think there is a case of Vedanta. Vedanta, I think, is going to demerge their units. I think into 5 units.
Mhm.
So now, why this reverse going trend is going on? Of course, there was a trend when there was a merger acquisition. Now this is reverse because it has been observed that when a unit is operating independently, it creates some more value also. So we can say that while merger acquisition is meant for synergy, the merger, or we can say basically demerger, is for the creating the value, and reverse merger for entering into the market. So these are basically broad difference between these concepts. So with this, almost we have completed this topic. This is merger
Yes.
acquisition and corporate restructuring. Now, student, in the next class, we shall Divas sir shall complete this topic. I think in first half, or say within 1 hour.
Yes, sir.
So after that, we shall
Yes.
start the last topic of our syllabus, that is startup finance, and we will complete our syllabus in the next class. So student,
Right, sir.
so it is very important you attend the last class so that your course is completed and your 100% 100 marks paper is completely well prepared. So Devas sir, just show the number, our contact number, as well as our email ID. Now I think all the doubts have been taken up. So still, if you have any doubt, you are free to contact us at this number. So with this, Devas sir, I thank you very much for
Sure, sir.
sparing your precious time and letting the student this
Thank you,
topic.
sir.
And student, we also thank you for that patient listening and making the session interactive. Thank you very much and have a nice day. Thank you all.
Thank you.
Thank you
Thank you,
very
sir.
much.
Thank you. Thank you.